Hi everyone, in this lesson we're going to connect the dots and integrate all three financial statements. We'll build on our Libra example to complete our full financial statements and add another year of activity to highlight the mechanics of these interlinking statements. We're going to approach this lesson a little differently as we'll first start off with our Excel exercise and then review the key points that we've learned from integrating the statements. Now that we've covered the basics of the three statements and have fully developed our income and cash flow statements, we'll need to rework our balance sheet for Libra. Now, this isn't necessary in real life, but since we started off with rudimentary assumptions for our balance sheet and then added complexity throughout our income and cash flow statement exercises, we'll need to rework our balance sheet now to reflect those additions. This slide shows all the transactions that we've entered in year one on our income and cash flow statement. We'll now move to the Excel exercise to finish out the balance sheet. Okay, so the first thing that we're going to do is link our cash balance right here from the cash flow statement. So what we'll do is go to cash and link it up from our cash flow statement. And the line item that we're going to be linking from is net change in cash. Okay, and now next, since we've sold $100 worth of scales for year one, but only $70 was collected in cash, we will enter $30 as accounts receivable. So this addition to an asset means that cash is tied up and was reflected in our changes in working capital section under the cash flow statement. So you can see that this number right here is -30. We didn't have any inventory left over for the end of year one, so we'll keep that at 0. And we also have $10 for prepaid expenses, which is actually our insurance amount since we prepaid $10 for insurance in which only $1 was used in year one. So that will provide us with $9 in prepaid expenses. So this would actually be $1 in current prepaid expenses since only $1 is going to be used up next year, and $8 are going to be remaining on the balance sheet as a non-current asset for the years after year two. We're going to total our current assets. So remember, alt equal sign gets us a total. Now keep in mind that in real life, prepaid expenses will almost always be listed under current assets. Having prepaid expenses that extend out over a year is a rarity. We have it listed out here for demonstration purposes only. Okay, so once we have all our current assets entered, we'll move on to the non-current assets. We've already entered the non-current portion of the prepaid expenses, so we'll move on to our equipment, property, and patent. Okay, so our equipment, we have $50, but since we actually depreciated a good portion of that, so we depreciated $50 divided by 10, which is 5. So what we're actually going to do to make our lives easier and cleaner is to go $50 minus our depreciation amount for equipment, which is 5, and that gets us to 45. Property, we'll do the same thing. So property, we have $200 in the beginning. We'll subtract our depreciation amount for property, which is 10, and that gets us to 190. Same with patent, we have a patent starting value of 50. Subtract the patent amortization of 5, and that gets us to 45. Okay, so we'll sum up all these items again, and that gets us to 288. We'll add up our total assets, so our non-current assets plus our current assets gets us to 530. Okay, so one thing that I want to note is that for our equipment, property, and patent, we're assuming that we're depreciating everything on a straight line method. And as previously covered, straight line method means that we divide. So we're going to look at our depreciation numbers. So straight line method means that we divide the value of our item by its useful life. And in the case of the patent, the useful life is time till the patent expires. So we'll divide that item and then subtract out any salvage value at the end of its life cycle. Just for simplicity's sake, we have all our salvage values listed as 0. Okay, so moving on to our liability side, we'll start off with accounts payable. And remember that we owe $20 in accounts payable because we only paid $30 for the $50 in materials that we purchased. Accrued expenses will be $3 since we used $5 worth of consulting services for the year but only paid $2. Okay, so our total current liabilities stand at 23. And next up are our non-current liabilities, and encompasses the 5-year loan that we took out in the beginning of the year, which was worth $100. And that's fairly simple. We have $100, which means that our total non-current liabilities is $100. And under shareholders' equity, we will enter the $400 worth of common shares, which is the money that we received in investor capital that we exchanged for shares of our business. And remember that we also paid $2 worth of wages in stock, so we have to enter that in here. So 400 plus stock-based compensation of $2. So there we have it. We have common shares of 402 at the end of the day. Okay, so retained earnings is going to be just our net income number because this is year 1 and year 0. There was 0 retained earnings. Okay, so total shareholders' equity is going to be the sum of these two. Total liabilities and shareholders' equity is going to be shareholders' equity plus our 2 liabilities numbers. So total current liabilities and total non-current liabilities. Oops. Should be a plus. There we go. We have $527 in total liabilities and shareholders' equity. And we also have $527 in total assets, which gets us to a balanced balance sheet. So 2 items to note. One is that our long-term debt number remains the same because we did not repay any of the debt principal from our bank loan. Second item is that stock-based compensation, we can think of it as employees receiving stock, and those employees now inadvertently invested into the company. So instead of paying them cash, we pay them stock. And because we pay them stock, it's like them funding us, and we are issuing them shares. So it's kind of like the initial investors who funded us with $400, and we gave them $400 worth of shares. So same principle. We're paying our employees $2 worth of stock, and essentially they save us from paying them $2 in cash. Okay, so now that we finished our year 1 activities and filled out our balance sheet, let's log in Libra's year 2 results. So during year 2, we ramped up our sales and marketing, and also people heard about how great our skills were. So as a result, we sold $150 worth of scales, in which $90 have already been received in cash. The scales that we sold costed us $70 to manufacture, but we produced $80 worth of materials, in which $50 has been paid for in cash. So since we produced more scales given the increased demand, we had to spend $10 to purchase more equipment. So this equipment was acquired mid-year and also has a useful life of 10 years. For operating expenses, we paid $12 in wages as we hired additional workers and paid $2 out in stock. We also spent $6 on sales and marketing as we ramped that up in order to sell more scales. We spent $3 on research and development, $3 on utilities, and $3 on consulting, which we paid only $2 in cash. We also thought to pay back some of the $100 bank loan that we have on the books. So we decided to pay back $20 of the $100 bank loan, and taxes remain at 21%. So feel free to attempt year 2 entries on your own or follow along as we walk through it. Okay, so let's get started. We'll first plug in our income sheet items, then move down to the other sections. For revenue, we'll input 150 as we've sold that much in scales. COGS, or cost of goods sold, it's $70 since the scales that we sold only costed us that much to produce. And that gets us to, so make sure that we add a negative sign here. So that gets us to a sum of $80 in gross profit. For our sales, general, and administrative items, remember that's operating expenses, we'll enter $10 for labor since $10 was paid for in cash, $6 for sales and marketing, $3 for research and development, $3 for utilities, $3 for utilities, $3 for consulting services again, so $3 for utilities, $3 for consulting services, and $1 for insurance, because even though we didn't actually pay money this year for insurance, $1 of insurance was spent this year on an accruals standpoint, and we're going to actually deduct that from our balance sheet. We'll see that in a second. That gets us to a total SG&A number of 26. And remember, we have to make this a negative number as it's an expense, which gets us to an even number of 54, which is a sizable improvement from year 1 where we had an even number of 28. Okay, so for non-cash expenses, there's a little complexity in how equipment depreciation is calculated. So what we're going to do is we take the straight line depreciation amount from our initial equipment value, which is $5, so $5, and add on the depreciation from the new $10 addition. But however, since we purchased a new equipment mid-year, we will only depreciate it for half a year. So you can see that we're going to take the depreciation value of the first year, and then we're going to add the new addition, which is $10, and a new addition of $10, we're actually going to link directly from here. So we'll add a number in a second, but we'll link it from there. And what we'll do is we'll set it up. So that divided by useful year of 10 years times 6 divided by 12, since it's only going to be depreciating for half a year. And so far you have 5. That number will reflect and change once we fill out our cash flow statement. Okay, so property is going to be pretty simple. It's going to be the same. Amortization is going to be the same. Our depreciation for now is going to be the same. So what we're going to do, an easy way of copying it over, so we don't have to set up a new formula, is just to highlight. So D20, highlight it, press Control C, and go Shift, right arrow, and then hold down Control and R. So that's just going to copy over this formula from D20 over to E20. So you can see it's the exact same formula, just different column. Okay, so stock-based compensation is going to be the same as well. So we're just going to, actually, you know what we'll do? We're going to take stock-based compensation, and we'll actually enter it manually. So 2, -2. Our EBITDA number would then be EBITDA plus depreciation plus amortization plus stock-based compensation, and that gets us to 32. So when we subtract interest, which is calculated as 4%, we actually added a line here that details out the interest rate. And what we're going to do is we're going to actually calculate it from, or calculate it by, rather, taking the average balance between the 2 years. So the average debt amount, we're going to do average of debt from year 1 and average of the average between year 1 debt balance and year 2 debt balance. So right now it's 100 because we haven't actually entered anything. Oops. There we go. We haven't actually entered anything within our balance sheet, but that'll get reflected as well once we finish out the financial statements. Make sure that this is a negative since it's an expense. Okay. Oops. And then multiply this by our interest rate. So that's 4%. And that so far is a interest expense of 4. We sum these items together, so that EBIT number plus our interest expense gets us to a pre-tax income or earnings before tax of 28. We take 21% of tax out, so 28 times 21% gets us to taxes of 6. It's actually, if we move this out a little bit, 5.9. And we end up with a net income number so far of $22. And you can see that this is significantly higher than year 1, and we'll discuss the implications of this in our next lesson. Next, we'll work on the balance sheet. We're going to skip cash, as we'll link that from the cash flow statement once we're finished with that section, but we can start tackling the rest. Accounts receivable, right here, since customers purchased $150 worth of scales, but only $90 were collected, accounts receivable here will be 60. Okay, so for inventory this year, we actually have inventory numbers of 10, since $10 were spent to produce the scales that were left unsold. So the current portion of our prepaid expenses is still 1, since this is now year 2, and there was $1 worth of insurance expense for year 2. The prepaid expenses, which is non-current, is now going to be 7, because there's now 1 year less in prepaid expenses since we're now forward a year. Okay, so our total current assets is 71, and that's without the cash number. Moving on to equipment. So equipment is calculated as prior year's equipment number plus our new addition to equipment, and our new addition to equipment, we're going to link from our cash flow statement. Okay, minus our depreciation amount for equipment. So right there. So right now it's 40. That's going to change once we fill out the rest of our statements. Okay, and our property, plant, and equipment, so same, but it's also a little bit more straightforward as we're taking just last year's value and subtracting out this year's depreciation, which is 10. So that gets us to a property value that's now 180. Patent is the same. We're going to take the prior year's patent value, which is 45, and we're going to subtract this year's amortization of 5. Okay, so the amortization is a negative value, so we have to add it together. That gets us to a total non-current assets value of 264. We add up both our non-current assets and our current assets to get 338. We'll remove the decimal space here. And remember, this number right here is going to change. Same with this number once we fill in our cash portion. Okay, so accounts payable under liabilities is at 30 since we purchased $80 worth of materials but only paid $50 in cash. Our accrued expenses is $1 since we paid $2 for the $3 worth of consulting services received this year. Long-term debt is now our previous debt number minus the repayment amount. So again, we're going to link up the repayment amount from our cash flow statement. So let's go down. We actually have a line here that's debt repayment. Okay. And then our total non-current liabilities is just going to be this number right here. Common shares is going to be last year's common shares plus the amount of stock-based compensation, or SBC, that we paid out for this year. So we're going to grab our stock-based compensation amount, and since we want to add it in there, we're going to have to subtract out the negative stock-based compensation that we have in our income statement. Okay, so our common shares is now 404. Retained earnings is going to be prior year's retained earnings plus our net income. So we have retained earnings of $24. Our total shareholders' equity now is going to be 428, and then we could copy over this same equation for our total liabilities and shareholders' equity, and that gets us to a number of 528. So you can see that obviously our balance sheet does not balance, and that's because, oops, this number needs to be added up together as well, and that's because we are missing the cash item here. Okay, so for the cash flow statement, we'll start off by linking our net income figure from the income statement. So we'll go ahead and link this up. We'll do the same for depreciation, amortization, and stock-based compensation, but note that these all need to be positive on cash flow statement as we're adding them back. So property, we'll link from here. Equipment, we're going to link from E21. Amortization, from E23, but remember, we're going to have to flip the sign to make it positive. And same with stock-based compensation. We're going to take it from the income statement, but we're going to have to flip the sign as we're adding them back to the cash flow statement. Okay, so these items here, depreciation number would be, if we move over the depreciation formula, remember that's Control C, and then Shift, right arrow, Control R. So depreciation is 15, amortization 5, stock-based compensation is 2. So same thus far as year 1. And that gets us to a funds from operation number. And again, we're going to move over this formula of 44. Okay, so under changes in working capital, we will subtract anything that added to our assets and add anything that has added to our liability section. So because our accounts receivables increased by 30 and is an asset, we will subtract the difference. Okay, so we take the difference of prior year's accounts receivable and current year's accounts receivable. That gets us to a accounts receivables change of $30. And since we're adding to our assets balance or assets side of the balance sheet, it's going to be a negative change in our working capital. Inventory is the same. So since we added to our inventory number, it's going to be a negative change in our working capital. Prepaid expenses is going to be similar. We're going to take prior year's prepaid expenses minus current year's prepaid expenses. So just make sure we have all the parentheses in place. And we actually have a positive figure in prepaid expenses because our prepaid expenses balance went down on the asset side. Under our liability side of the working capital portion, we have accounts payable. And so we're going to actually subtract accounts payable numbers from current year by the prior year. And we can see that accounts payable actually increased by 10. And since we're increasing our liabilities, it's a net positive cash flow. And which means that it's a change in working capital, a positive change in working capital. Okay, so same with the accrued expenses figure. We're going to take current year's accrued expenses minus prior year's accrued expenses. And that gets us to a negative change of $2. And that's going to be a net cash outflow since we actually decrease our liability section of the balance sheet. Okay, so summing up all these working capital items, so we'll again copy over this formula. We can see that our working capital figure is negative 31. This means that in year 2, we had more money tied up in working capital, and most of that came from our increased accounts receivables balance. So subtracting the changes in working capital from funds from operation, so we'll just add these two numbers together, gets us to a net new operating cash flow figure of 13. Okay, so investing and financing activities are fairly simple in year 2 as we spent $10 in purchasing additional equipment. So $10. Remember, we're just copying over the formulas. And we spent $20 paying back debt. This is actually going to be a negative number. Oh, we have to actually reflect that here. So all we did here was change the negative sign to a positive sign because our debt repayment is a negative number. So we want to make sure that we're subtracting our debt repayment from our long-term debt. Okay, and that gets us to a net financing cash flow of -20 and net investing cash flow of -10. And our net change in cash will then be -17. But hang on a second, I think we made an error in our depreciation number for equipment. So what we did was we used the E90 number, which is property. So we meant to actually use the E91, which is the equipment investing activities number. And as you can see, our new depreciation for equipment is now actually 5.5. So an increase of 0.5 over our prior year's depreciation number of 5, and that includes our new depreciation amount, which is half a year for our $10 addition. So $10 addition in equipment. Now our net change in cash is $6. I mean, actually it's 16.5. We'll round it down in this case, since it's 16.46 to 16. Our free cash flow is 4. And even though our net change in cash is negative, it's actually not necessarily bad, as cash was used to invest into the business. So $10 was used to purchase more equipment, and $20 was used to pay back debt. So now we're going to link up our cash number. So our cash number would be prior year's cash, our balance sheet, plus our change in cash. And that gets us to 191. Okay, you can see that everything I needed to adjust has adjusted. Our balance sheet now is balanced. And there you have it. We completed year 2's financial statements. Next up, we are going to go over some basic financial statement analysis to review some of the ratios and trends that we're seeing in Libra's financial statements. So stay tuned, and I'll see you next time. Bye-bye.